Have you ever wondered how a tiny brand new company can suddenly show up and take down an industry giant? You know, one of those household names that's been around forever? Well, today we're digging into exactly that. We're going to break down something called disruption theory, and we'll use the ongoing battle between flashy fintech startups and traditional banks as our real-world example. Let's get right into it. So, it all really kicks off with this one central mystery. Why do these huge, successful, and often very well-managed companies just fail? It's almost never because they got lazy or stopped caring. The real answer is actually a predictable pattern, a kind of trap that even the smartest people in the room can fall right into. And the key to solving that mystery? It's a powerful idea called disruption theory, which was pioneered by the legendary Clayton Christensen. See, his big insight was this: disruption isn't about the new guy building a better product, not at first anyway. It's about them making something simpler, cheaper, and way more convenient for the customers that the big, established companies have started to ignore. Okay, so to really get this, we have to understand that disruption isn't just some random lightning strike. Nope, it follows a surprisingly predictable pattern, almost like a life cycle that plays out over and over again. You see, most industries go through these stages. It all starts out kind of messy and chaotic. That's the probe and learn phase, where everyone's experimenting. But then a dominant design eventually wins out. Think of the QWERTY keyboard, it just became the standard. From that point on, companies stop competing on wild new features and start competing on making things cheaper and more efficient. But after a while, the improvements get smaller and smaller, the market gets mature, and that right there is when the door for disruption just swings wide open. And this slide, this really lays out the two sides of the coin perfectly. Over on the left, you've got the big established players. They're all about sustaining innovation, making their existing products a little bit better for their most profitable customers. But then, look to the right. That's the rocket ship of disruptive innovation. It's not about being better, it's about being different. It's simpler, it's more accessible, and it's aimed at all those customers the big guys left behind. At first, it might even look kind of like a toy, but it gets better, and it gets better fast. Let's use a classic example to make this real: Kodak. Now, you might think they just missed the boat on digital cameras, but that's not what happened at all. They knew digital was coming. In fact, one of their own engineers actually helped invent the technology. So what on earth went wrong? And here it is. This is the absolute heart of what's called the innovator's dilemma. Kodak's entire empire, all its profits, came from selling film. That was their cash cow. So embracing digital cameras meant they'd have to kill their own cash cow. If you're just looking at a spreadsheet, protecting those film profits seems like a totally rational business decision. But in the real world, it turned out to be a fatal one. Okay, now let's fast forward. Let's leave the world of film and jump right into the world of finance. Why? Because that exact same Kodak story, it's playing out right now, today. Only this time, it's between the traditional banks and this whole new wave of fintech startups. This table basically shows you the whole attack plan. Just look at who they're targeting. The banks are focused on their most profitable, established clients. Meanwhile, fintechs are going after all the niche, underserved groups. And the offering? Banks give you these complex, full-suite products, while fintechs offer super simple, single-purpose solutions. And the model itself? Banks are heavy, with all their physical branches, while fintechs are digital-first, built to be low friction. It is a completely different playbook. And they are launching these attacks across the entire financial map. We're talking about everything from simple payments and faster lending to more accessible investing in insurance. Each one of these is like a small foothold they're gaining in the bank's territory, and they're doing it simply by serving a need that was being ignored. So you have to be asking, how can a tiny startup with a handful of employees possibly compete with a multi-billion-dollar bank? Well, it's not magic. It turns out they have a structural advantage, a kind of secret weapon that's baked right into their DNA. And that weapon is called the asset-light strategy. See, instead of owning everything themselves, physical branches, massive server farms, huge workforces, fintechs build their entire business on software, on cloud services, and on strategic partnerships. The bottom line is, they own less, which lets them do so much more. I mean, the contrast here could not be more stark. Banks are asset-heavy. They're literally weighed down by physical real estate and clunky old legacy tech. They're what we call vertically integrated, which just means they try to do everything in-house. But fintechs, they're asset-light. They use cloud infrastructure and build their services like they're snapping together Lego blocks, using APIs, which are kind of like digital handshakes, to connect with partners. And this is what makes them unbelievably fast and agile. But here is the really crucial part. This lean, asset-light model doesn't work in a vacuum. It's not a solo act. It is completely 100% dependent on a whole network of partners, an entire ecosystem of other companies that provide the fuel for this rocket ship. And building this ecosystem isn't just about making a few phone calls. It's a very deliberate, strategic process. It starts by scanning the market for the right partners, assessing what they can do, defining the business case, and then actually executing and governing that partnership over time. This ecosystem becomes this incredible engine, not just for being efficient, but for driving future innovation. All right, so what happens when these two completely different models, the heavy incumbent and the lightweight disruptor, finally clash in the real world? What are the actual outcomes of this fight? Let's take a look. What's so fascinating is that it's not always this winner-take-all bloodbath. Sure, sometimes a fintech completely substitutes what a bank used to do, but just as often, they end up becoming complementary. They provide tools and tech that actually make the bank better. And very frequently, you see this hybrid state where they're competing in one area while partnering up in another. So disruption is often about integration, not just total destruction. Okay, so we've gone through the theory, we've looked at the examples, the strategies. What is the single most important idea you should walk away with from all of this? It really comes down to this. The technology is just the tool. It's the enabler. The real disruption is the brand new business model, one that's leaner, faster, and laser-focused on solving the friction points and frustrations that customers have, the ones the old models just couldn't fix. It's all about completely redesigning how value gets delivered to you. So, why does any of this matter to you? Well, because this isn't just some abstract business theory. This is something that directly affects the institutions that we all trust with our money, and it's actively shaping the future of finance for every single one of us. So, I'll leave you with this final thought to chew on. Think about the company you bank with, the one you invest with, or maybe even the one you work for. Is its structure, its cost model, and its whole mindset built to protect the past? Or is it agile enough to compete in a world where these asset-light, ecosystem-driven companies are fundamentally changing the rules of the game? The answer to that question is probably going to determine its future. Thanks for tuning in.